Before we begin, a quick note. This video is for educational purposes only. It is not financial or investment advice, and I am not a SEBI registered advisor. Now let's understand candlestick charts in a very simple way. A candlestick may look technical, but the idea is very simple. One candle represents one block of time. That block could be 1 minute, 1 hour, or one full day. A single candle tells the full story of price movement during that time window. Every candle tells a short story with 4 key prices. It starts at the open. During that time period, price moves around and reaches a low and a high. When the time ends, it stops at the close. So every candle is really a summary of open, low, high, and close. If the closing price is above the opening price, the candle becomes green. That means price ended higher than where it began. In simple words, buyers were stronger during that time block. If the closing price is below the opening price, the candle becomes red. That means price ended lower than where it began. In this time block, sellers were stronger. Sometimes price moves a lot during the time period, but finally closes at almost the same level where it opened. That creates a doji. A doji often suggests indecision, because neither buyers nor sellers clearly won. When many candles appear one after another, they form a chart. Once you understand the meaning of one candle, you can start understanding how the market behaves across time. So here's the full idea. A candle shows open, high, low, and close. If price closes above open, it is green. If price closes below open, it is red. If open and close are nearly the same, it is a doji. And that is the basic logic of candlestick charts. Once you understand this, charts become much easier to read.